Joining us is Andy Walden. He's Vice President of Enterprise Research at Black Knight. Welcome back, Andy. What particular markets jump out at you here?
I mean, there's a handful of different markets when you start to look across the country. A third of major markets are now the least affordable that they've ever been, including some big names on there. You've got Phoenix, Atlanta, Dallas, Denver, Portland, San Diego, among many others. So a lot of areas across the country starting to feel that pressure.
Let's talk about affordability. So I see here that the monthly payment to buy the average home has risen by $500 a month just this year.
Yeah, that's absolutely right. That's a 40% increase over the last 4 months. And when you expand that timeline out over the life of the pandemic, we're talking $800 per month to buy the exact same home that you could buy at the beginning of the pandemic, which is a 70% rise. So again, across the board, we're seeing some severe tightening here from an affordability perspective.
And we had seen home prices on a steady increase, but this is clearly a pandemic shift where both prices, now rates are going up. What's the effect so far on the number of mortgage applications we're seeing, on the pace of home sales? What's your data telling you?
Yeah, and so through really March, we had seen purchase volumes hold relatively strong. I think that's expected to change here as we move throughout the latter part of the year. When you start to see interest rates rise, it's not only a disincentive to buy, it's a disincentive to sell. You have a third of mortgage holders that have a rate locked in at 3% or below. Half have a rate locked in at 3.5% or below. You're mentioning 30-year rates are now up in the 5.5% range. So not only is it a struggle to buy homes out there, but folks have a strong disincentive to list their home for sale as well, which really limits the overall volume expectations out there in the market.
Makes so much sense because even if you wanted to rent, rents have been surging as well. So you think basically that, I don't know whether we want to say activity or just the market kind of peaked in March, and you're expecting us to see maybe continued moderation in prices and sales, maybe to some extent inventory.
Yeah, that's absolutely right. And I think there are a couple major fuel sources pushing the market. One of them was the record low rates and strong affordability that we had been seeing. Given the rises in prices and rises in interest rates, that incentive is now gone. That affordability is now gone out there in the market. We're now the least affordable we've been outside of a 12-month window in 2005 and 2006. We still do have some upward pressure from the supply side. We're still 70% short on inventory out there. And so that's going to keep prices a little bit higher than they otherwise would be. But I think we are going to see, I think moderation is a great word. It is going to be the word of the year as we move throughout the tail end of 2022.
So finally, tell us about these ARMs, these adjustable rate mortgages, because you'd think this would be the last kind of environment anyone would want to take one out. But as Diane Olick reminded us the other day, a lot of them have 5 or 7 year lock-ins and then they reset. So people might be thinking, I'm just going to wait out this inflation bulge. I'll move by then. I'll avoid the rate reset and it'll all be fine.
Yeah, I think there are a couple different reasons why people are looking at ARMs. One, we just mentioned it, it's extremely unaffordable out there in the market. Folks are looking for ways to maneuver and ways to adjust out there in the market. The second is that ARM rates are extremely attractive right now. You can get a 1.25% lower ARM rate than you can on a fix. That's the most attractive ARMs have been since 2014. That said, I'm not as concerned as I otherwise would be. We're still talking less than 10% of the market is adjustable rate mortgages compared to 40% back in 2005 and 2006. And as you mentioned, the initial term on a lot of these, 80 to 90% of these ARM originations have an initial fixed period of 7 or 10 years. So they operate like a fixed rate loan for an extended period of time, which gives the market and those homeowners and home buyers a little bit more security.
Yeah, still, I'm like, ooh, it feels like a ticking time bomb if it were me. Andy, thanks for your time. Good to see you.
Absolutely.
Andy Walden with Black Knight.